Here is the biggest number in business today, and almost nobody can tell you who's paying it. McKinsey estimates that meeting projected demand for compute could require $6.7 trillion in data center investment by 2030. Call it the $7 trillion bet. Every one of those dollars has to come from somewhere. A shareholder's dividend that wasn't paid, a bond a pension fund bought, a line on your electricity bill. And every one of those dollars is a bet that artificial intelligence will eventually generate enough revenue to pay it back with interest. So in this episode, we follow the money through the entire stack. Who spends it, who pockets it, and who's exposed if returns disappoint. Because the honest answer to who pays for AI is probably you several times in ways you haven't noticed. Start with the four companies doing most of the spending: Microsoft, Amazon, Alphabet, and Meta. In 2024, their combined capital expenditure was roughly $230 billion. In 2025, it reached around $400 billion. For 2026, company guidance and analyst tallies put the combined figure somewhere between $600 and $725 billion. At the high end, that's 77% growth in a single year. For scale, the entire US interstate highway system cost about $300 billion in today's money, spread over 4 decades. Wall Street is split. Jefferies analyst Brent Thill calls the bear thesis garbage, pointing to surging cloud revenue. Skeptics note that companies built on software margins are becoming industrial borrowers with industrial risk. Both sides agree on one thing: nothing this large has ever been attempted by private companies this fast. Where does a data center dollar actually go? The biggest slice buys chips. Nvidia sells AI accelerators at gross margins around 70%, which is why it became the most valuable company on Earth. Every gigawatt built anywhere is a toll paid to Nvidia, and behind it TSMC, which fabricates nearly all of it. Next, memory. High-bandwidth memory is now so scarce that reporting attributed roughly $25 billion of Microsoft's latest guidance to memory costs alone. Then the physical world: land, steel, construction, and gas turbines, where manufacturers like GE Vernova are reportedly sold out years into the future. Notice the pattern. Everyone in the supply chain gets paid now, in cash up front. The AI companies at the top of the stack get paid later, maybe. That timing gap is the entire risk of the machine economy, and it's why how the spending is financed matters so much. For the first years of the boom, hyperscalers paid cash from their enormous operating profits. In late 2025, something changed. Meta struck a $27 billion financing deal with private credit giant Blue Owl for its Hyperion data center in Louisiana, reported as the largest private capital deal ever, using a special purpose vehicle that keeps most of the debt off Meta's own balance sheet. Weeks later, Meta sold $30 billion of bonds, among the largest corporate bond sales in history. Oracle raised $18 billion in debt. Even Alphabet, despite its cash pile, issued tens of billions in bonds. Bloomberg has described the roughly $3 trillion near-term build-out as becoming all-consuming for global debt markets. When spending moves from cash to debt and from balance sheets into special-purpose vehicles, the risk doesn't disappear. It migrates to bondholders, private credit funds, and the pensions and insurers behind them. Now for the strangest structure in modern finance. In September 2025, Nvidia announced up to $100 billion of investment in OpenAI, money largely destined for systems built on Nvidia chips. OpenAI signed a deal with Oracle, reported at roughly $300 billion over 5 years. Oracle, in turn, buys enormous volumes of Nvidia hardware. A deal with AMD includes warrants for roughly 10% of AMD itself. Add the $500 billion Stargate venture with SoftBank and Oracle, and CNBC has tallied over $1 trillion in interlocking commitments, against OpenAI revenue reported around $13 billion in 2025. Critics call this circular financing, suppliers funding their own customers, echoing the vendor financing that preceded the telecom crash. Defenders, like economist Noah Smith, argue the deals are contingent on real deployments serving real demand. Both can't be fully right. The answer decides whether this is infrastructure or leverage wearing infrastructure's clothes. Time to answer the title question. Group 1. Shareholders. Every CapEx dollar is cash that could have been dividends or buybacks, and free cash flow at the tech giants is shrinking despite record profits. Group 2. Lenders, the bondholders and private credit funds, which ultimately means pension funds, insurance companies, and retirement accounts. Yours possibly. Group 3. Taxpayers, through the tax abatements, incentives, and infrastructure subsidies that states offer to attract data center campuses. And Group 4 pays whether or not they've ever typed a prompt. Electricity ratepayers. Because the constraint on this entire build-out is no longer chips or capital. For the rest of this episode, we follow the wire into the wall because the power grid is where the $7 trillion bet collides with the physical world. A Department of Energy-backed study found data centers consumed about 4.4% of US electricity in 2023, and projected that could reach as much as 12% by 2028. The new AI campuses are measured in gigawatts. A single gigawatt is roughly the draw of San Francisco, and the grid was not ready. Interconnection queues stretch years. Transformers and gas turbines are back-ordered toward the end of the decade. It's why Microsoft signed a deal to restart a reactor at 3 Mile Island, and why hyperscalers are becoming, functionally, energy companies. Power is now the gating factor on the entire stack. You can wire money in a week and fabricate a chip in months. But a new transmission line or power plant takes the better part of a decade, which creates a brutal collision, because households and AI campuses are now bidding for the same electrons. In PJM, the largest US electricity market, capacity auctions have hit record prices in back-to-back years, with grid operators and analysts pointing to data center demand as a primary driver. Reporting this summer found capacity costs up roughly 60% as supply fails to keep pace. In data center corridors like Virginia, Ohio, and New Jersey, household bills have climbed by double digits, and utility commissions are fielding angry questions. Some states are now designing special tariffs to force data centers to pay their own way. The industry warns that could push construction elsewhere. Understand what this is. A cost of the AI build-out arriving on the bills of people who never invested a cent in it. Of the 4 groups paying for AI, ratepayers are the only ones who never opted in. And politically, that's becoming the most explosive part of the whole bet. So will the bet pay off? Here's the arithmetic that should keep executives awake. Bain and Company estimates that by 2030, the AI industry needs about $2 trillion in annual revenue to fund its computing demands, and projects it will fall short by roughly $800 billion a year. An MIT-affiliated study found about 95% of enterprise generative AI pilots were producing no measurable profit impact. That's the bear case. The bull case is also real. Cloud revenue is accelerating. Nvidia's order books are full. Backlogs run into the hundreds of billions, and prior estimates of AI demand have repeatedly proven too low. The truthful position is that nobody knows it. The revenue curve and the spending curve are both going up, and the entire question is whether they intersect before the debt comes due. Which brings us to the scenario nobody building this wants to discuss. Chips are not railroads. Hyperscalers depreciate AI hardware over roughly 4 to 6 years, and critics, most famously investor Michael Burry, argue the real useful life is shorter, meaning today's reported profits may be overstated by billions. If AI revenue disappoints, the losses land in a sequence. Equity holders first, trillions in market value repricing. Then the debt, the bonds and private credit vehicles, where losses would surface in pension funds and insurers years after the fact. Then the towns and ratepayers left with infrastructure built for demand that didn't come. The telecom bust of 2001 vaporized enormous market value, but the overbuilt fiber became the cheap backbone of the modern internet. AI's version is less forgiving. Dark fiber lasted decades, while a stranded GPU ages like fish, not wine. The power plants and buildings will outlast any crash. The chips, the biggest slice of the 7 trillion will not. So let's reframe where we started. The $7 trillion bet isn't really one bet placed by a handful of tech CEOs. It's millions of small exposures, quietly distributed to shareholders through vanishing free cash flow, to savers through bonds and private credit, to taxpayers through subsidies, and to ratepayers through the grid, most of whom have no idea they're holding a position. That's not automatically a scandal. It's how every great build-out, from railroads to electrification, was financed. Some made fortunes, some made wreckage. The tell to watch is the financing itself. When the spending migrated from corporate cash to record-breaking debt, that was the system's honest confession about scale and risk. The financing always tells the truth before the earnings calls do. If you want to keep following the money through the machine economy, subscribe. The next layer of the stack is coming.